But let's talk a little bit about tax strategies. So today is October 23rd, which means we have a couple of weeks, maybe a few months till the end of the year, and this is the time that we work with clients to get their strategies and all the things that they need to do to make sure they are optimizing taxes, optimizing different types of strategies. Maybe they're not doing any strategies. Maybe it's time to convert to some kind of other tax structure. So I guess I could talk about a lot of the things that are happening now with some clients and prospects. So I'm getting a lot of calls from prospects that are making money. They either just filed their tax return with another preparer. The other day someone did not prepare their tax return because they didn't like the result, because they were paying like a nice amount of taxes, and they even sent me the tax return and I reviewed it, and it's like, yeah, this is totally wrong, and they need to work on their bookkeeping to be able to get better numbers, because there was so many deductions that a normal real estate rental advisor would have, and he didn't have those on his tax returns. So yeah, I told him go rework it. I actually gave him a bookkeeper, because even though I do some bookkeeping, I tried to outsource that to a friend of mine to do the bookkeeping because they have a team. I'm more of a tax advisor consultant, so I don't want to get into the weeds of bookkeeping. It's not something that excites me, although today and yesterday all day long I was in QuickBooks fixing the books from a client, but it's not bookkeeping, it's more adjustments, putting depreciation where it's not being taken. And okay, so let's see if people are joining from whoever and from wherever. So on the topic of bookkeeping, by the way, that is probably the basic thing that so many people don't have going on for them. And it's near impossible to even do planning until you have your numbers together. And I have a handful of clients that we need to catch up on bookkeeping. Some of them are still not doing, or QuickBooks or anything. They're still not together, and I'm going to be reaching out to a lot of them and to say, hey, we've got to get your stuff into some kind of system. If you want me to do it, fine. I have other bookkeepers that we can do that. And once we have the numbers, and like we can sit down and we year-to-date numbers, what have you made so far this year, and are you at the right level of deductions, and are you going to get whacked with taxes? Most of the time we look at it and say, okay, well, you made $100,000 and you're a single member LLC, and you're really at that point where maybe we should convert to an S-Corporation, and then we'll talk about S-Corporations and how that works. And if any of you don't know what an S-Corporation is, it's basically it's an entity that income from that you don't pay Social Security tax, but on top of that you need to do salary. You can't get away from Social Security tax completely, like self-employment tax. You need to do some reasonable salary, and that is one of the main reasons why someone would want to get an S-Corporation, is to just minimize that Social Security tax. Because if it was a sole proprietor or a single member LLC that goes on your tax return on a Schedule C, typically, if you had a net income of $100,000, Social Security tax for a self-employed individual is 15.3%, so that's $15,000 roughly. You get a little bit of a deduction for that. But if it was in an S-Corporation, you would have $100,000 of income and only get taxed on income tax, and not that additional 15.3% on S-Corporation tax. So, but IRS doesn't let you just not do any Social Security tax. They make you take a reasonable salary in that S-Corporation. So reasonable is subjective. So there's different ways to figure out what you would pay someone to run your whole business. So on $100,000, maybe $50,000 is reasonable. So on $50,000, you'll pay Social Security tax in a different kind of way on a W-2, and then your 15.3% is on $50,000 versus $100,000. So that's one of the things we do for year-end planning. And some people already have an S-Corporation for years, but they don't always take salary throughout the year. So towards the end of the year, we look, have you taken any salary? And if not, we go ahead and we make them take salary, and we file the appropriate forms. Sometimes they didn't take enough salary, so you never know, because you don't have to take more salary than you make in income. So it depends on your business, but maybe you don't know, so you wait until the end of the year. So different formulas. I like to always take something throughout the year, so this way it's evenly done. But you do like a minimum salary, like $1,000 a month or $5,000 a month, and then at the year end we can plan for, did you make large enough salary to be compliant with reasonable salariness. And there's also other planning we do. It's called retirement planning, and that's very much tied into your W-2, especially for S corporations. Some people have no S corporation, so we still can do retirement planning, self-employed set plans. So those things you should be thinking about as well. Depending on if you have employees or not, there's timelines for setting up certain things like 401k. Like October 1st was the deadline to do a 401k plan if you have employees. If you don't have employees, you're just a solo member, you can do a solo 401k. You can still set that up if you're an S corporation. So you got to kind of, not be sleeping throughout the year, but sometimes at the end of the year you have better figures, so you can for sure update where you've been. So there'll be a lot of clients that I have, and I work with multiple type of businesses, not just real estate investors. I have doctors, lawyers, ALF, nursing home clients. One guy does, he's like a tech guy. He does like a software company. Anyway, what we do for a lot of these, I work with a lot of clients in different states. So some states now allow you to do something called PTET, pass-through entity tax. So if you have an entity, you can actually pay tax at the federal level, and that tax is a state tax. So for example, Virginia, I'm from Florida, but I have a Virginia client, and they'll pay taxes from the business and get a tax deduction from federal, and that will pass through to their personal return as a credit for state taxes. So all the money that they make in the business, it happens to be an S corporation, that tax will be paid at the federal level and get deducted there, and it's just a better way of getting a deduction. And it used to be that you were limited on your personal return by $10,000 for state taxes and real estate taxes. Now you have $40,000, so some people might still get a benefit by not doing PTET, but depending on what you're doing, that's if you're itemizing. If you're taking a standard deduction, it probably makes sense to do a PTET deduction because you are reducing your federal deduction. And so this is another thing that we plan now, and there's a lot of planning. I probably should have said this before, but with Trump's OBBBA tax changes, a lot of things have been updated, like that PTET and itemized deduction new cap. There's bonus depreciation now if you bought your asset after January 19, 2025. So maybe that's another thing we do year-end planning for. I'm jumping around as things come to my mind. This is impromptu. It's my first live session, so bear with me. You can always comment, I guess, at some point to say how I did or what you want to hear, because I'm exploring. I'm exploring social media, trying to figure out what people want to hear. How do I present material? Do I have to be funny? Sometimes I'm a very funny guy. Sometimes I'm very serious. Sometimes I'm just like impromptu. I don't really care to be reading off a script. I did put a little chat GPT here. I asked it questions like, what should I talk about? But I haven't really even read that. Another thing, I actually just read it. So another thing that we check up on now is for those who have an S corporation. See, I keep on saying S corporation because for most service businesses and most businesses that are not real estate, S corporations make sense for them if they're making over $100,000. There's something called the accountable plan. You can look that up. I have a ton of content on that. It's all over the world with content there. But what that is the reimbursable plan. And it really is just a piece of paper saying you're going to reimburse yourself or your employees for things that you couldn't really pay directly from the business. An example is a home office deduction. You can't really pay your real estate tax and your utilities and all these mortgage interest from your business account, pro rata, whatever. So what you do is you say, well, I do have an office. I'm sitting in my office right now, even though I have this green screen on in my home. I actually rent an office too, but I find it more comfortable to be at home. So this whole room here that I'm looking at is completely basically mine for the office. I got some exercise equipment, I got a table, and it's a complete room. It even has a bathroom. But I want to get a business deduction. So what I do I have an S corporation. You cut a check for the pro rata amount of what that home office cost you. So in my case, I have real estate tax, I have utilities, I have insurance, and then you also have to look at how much you paid for your house, depreciation, and you take let's say this room is 150 square feet or 200 square feet over 2,500 square feet. So whatever that percentage comes out to be, a lot of times it's like 10, let's say 10% of your home is your office. So if your total expenses overhead to run your house was $50,000, so 10% of 50,000 would be $5,000. And then if your house was $500,000 and you take a 27.5-year depreciation, some people do the 39-year depreciation because it's like a corporate office now. 27.5 year is for residential, but if I'm talking about this is a business office, so probably 39 years, which is makes it a little bit worse. But anyway, you figure out how you're doing your depreciation, and boom, let's say $5,000 depreciation. So my deduction or my reimbursable amount is about $10,000. And what you're supposed to do is, from your S Corporation business account, you send a check to me personally, from my business to me personally. Do it once a month, do it once a quarter, have some backup for how you calculated that, and you reimburse me. I'm an employee of my S-Corp, and you take a deduction for it. So it's called a reimbursable plan, and you want to do that throughout the year. Now, some people don't do it right, or they didn't do enough, and they have to true it up or true it down if they did too much, and that's something we do at the end of the year, and that's home office. Your auto is not being listed on your business sometimes because your business didn't buy the vehicle, or whatever, you bought it years ago. Well, if you track your miles and you track the usage of your car for your business, you can take a deduction for that, either actual or miles. Everything you do here, by the way, you have to log what you're doing, because the IRS, if they ever ask you, they can ask you, well, where are you going? In my case, how much do I use my car? I run to the post office sometimes to mail in tax returns or payments or whatever. A lot of times I'm going to see clients. They want me to come to them, so I'm doing that. I actually have another business, not a big business, but it requires me to drive around, make deliveries and who knows what. So I'll take a deduction on that business. So you got to track your miles. So in a reimbursable account, you can reimburse employees, not just owner employees, any employee. They submit to you some kind of accountable plan expense reimbursement sheet, and then you look at it and you say, okay, I approve it. I'm an officer of the S-Corp. I approve it. Here's a check for $422. The key is, don't send a reimbursement for like a very round number every month, like $500 every month, because that's a non-accountable, because you're not accounting for anything. You're not reimbursing specific. You have to reimburse specific for accounting, for expenses. The same thing with your office, your home office. And a lot of clients do this. They are either lazy or they just uneducated, or prospects do this. They'll just do, well, a home office is about $1,000 a month. That's what I would pay anyway in rent. So they just cut a check for $1,000 every month. The problem is you're not reimbursing specifically for the expenses that you incurred. So that causes a problem. We used to do it in the olden days where, okay, well, it's not a reimbursable account, but so now you're going to have on your personal return a little home office rental, and you'll have $12,000 of rental income, because I paid myself $12,000 rental income, and then from there you can take a pro rata of your mortgage interest, your real estate depreciation, and real estate taxes and utilities. But that actually doesn't work a lot, like so well, because you end up having a little bit of extra income there, and that's another way. It's called a self-rental. But accountable plan works so much more seamless if you just follow the plans, you follow the steps, you follow the rules of what that means, and you're reimbursing for specifics, very specific. Another thing that we do for clients throughout the year, you probably hear me talk about, is the hire the kid strategy. So sometimes they didn't really pay the kid properly throughout the year, and or maybe they haven't been recording the actual things that the kids were doing, and we'll catch up with them and say, hey, you usually do a hire the kids. Have you been hiring your kids? What are your kids doing? One of my clients owns auto shops, multiple auto shops, and they do it every year. They hire the kids. They do it right. They do a W-2, and they had an S-Corp, but they opened up these management companies because they're managing different things, including the different auto shops. So I tell them every year, let's get your documents together. How many hours did your child work? Let's make sure you're not overpaying your child, because everyone's trying to get that $15,000. If anyone doesn't know what hire the kids strategy is, hire the kids strategy is basically shifting income from your tax bracket to your child's tax bracket. And if your child's tax bracket is zero, if they make the standard deduction or less, so $15,000 in 2025, so you can shift $15,000 to each child and then not pay tax on that. And if you're under 18, the whammy, you don't have to do Social Security tax for under age 18 kids. So, but you have to pay them from either to get that SC tax strategy, you have to pay them from either an LLC that's owned by the parents, that's not an S-Corp, a single member or a multi-member, but both parents have to own the multi-member, or a single member or sole prop. You don't even have to have an entity. You can be a sole prop, but you have to register to get an EIN in a sole prop to get the W-2 filed, because you should do a W-2. It just makes the paperwork better. A lot of people argue online, now you don't need a W-2. You know, you're under 18, and if the only employees you have in that management company is your kids, you never have to pay any taxes. Well, it's a problem, because if you get audited, they're going to ask you for documentation, and a lot of times they'll just ask for the W-2, and if you can't produce the W-2, then they'll be like, yeah, well, now produce me all the other documents that prove that your kid was working for you, and that sometimes is hard to you know, come up with. That's why I tell clients, let me look at what you've done to see if you actually have good substantiation to be able to prove that your kids work for you. And so W-2s is great. This client with the cars at the auto shop, they did the W-2s, they did everything right. And also when you're in states, you have to be careful when you hire your kids, because some states will require you to do withholding, because states don't always have a deduction or a standard deduction like the federal. So you might owe some taxes to the state that you live in for your kids. And so doing W-2s, you can actually withhold and pay taxes to the state from your W-2 with your ADP or Gusto, or I wouldn't advise doing payroll by yourself. I would actually get a Gusto or an ADP or Paychex. It's about $50 a month to get your payroll done, and that is the smartest thing to do. You register with the state and just do everything legit, and then now you have a legit strategy. Make sure you pay your kids for the things and they do for your business, and you don't always have to do this strategy. It's only if the kids are working. Now, on top of that, a lot of people like talking about, well, if you have the W-2 and the kids have earned income, what do you know? They can put money into a Roth IRA, and you can start putting money away for your kid. It doesn't have to be the $6,000 or $7,000 that you're allowed to put in per kid. You can put in $1,000 and let it grow tax-free. So another reason why you want a W-2, because the IRS will most certainly send them a notice out to you, because if you do a contribution to a Roth IRA, that gets reported to the government, to the IRS. There's a form. And if they don't match it to a W-2 of earned income, you're going to get a notice, hey, you can't put money into a Roth IRA. What are you kind of doing? Trying to do silly stuff? So for sure, if you're doing a Roth IRA for your children as well, you got to do a W-2. Anyway, the biggest scam, I'm not going to call it a scam. I'm sorry, this is live. I'm not sure if I'm recording it actually. There's something that you're going to see online. Everyone's talking about it. It's called the Augusta Rule. Yeah, let's see if 1,000 people just join. Augusta Rule is a cute little thing, and it's not something we necessarily do at the year end, but we'll talk about it. Are you doing events? Are you doing a holiday party in your house for your kid, for your kids that you hired that are the board of directors? That doesn't mean it's legit. So Augusta Rule is a cute little thing. Don't overdo it. Look it up. You can pay yourself fair market value rent as if you were going to go down to the Hilton and rent that space for that holiday party, that board of directors meeting, that networking party. And the way that works is if you cut a check from your corporation or your business entity, and that is not going to be taxable, because I didn't say the key thing is 14 days or less, you're allowed to do this. You're allowed to rent your house for 14 days or less. So if you do more, then you're screwed. Then you have to pick that up on your personal return as rental income and then deduct whatever kind of expenses you might have, similar to like a home office. So don't do more than 14 days of event rentals. Now, this home office that I'm in, I'm not doing my party in my home office. That's a separate deduction. But in my living room, my dining room, my backyard, my pool area, my driveway, that is where I might do an event for whichever reason. And I probably should do events, in my case. Networking events. That's how you get good business. The best clients I get is word of mouth, and people who just like, oh, I didn't know you were an accountant. And this, I just got a client recently. I've known him for years. He has a lot of real estate. And he actually Googled me. It's the strangest, crazy thing. And he needed an accountant. And he's like one of my biggest clients now. He just started a few weeks ago. Anyway, so networking is great. Augusta Rule is great. Don't overcomplicate it, and don't stretch the truth. I used to review tax returns for Augusta Rule and other things. I used to work for a CPA where I did some consulting, and she was one of these people that did a lot of these strategies, and every single client got every single strategy. And I told her, listen, $3,000 a night to rent out your home is ridiculous unless you have a mansion. Okay, most people have a 3,000 square foot house. You can't get $3,000 if you go to the Hilton. It's going to be probably a $500 or $1,000 for the same space. So don't overdo it. Okay. And okay, a couple other things that we do year end is okay. Well, now that we have our bookkeeping all in a row, we see your income. We've already did your retirement planning contributions, and you decided what you're going to do. Some things you can do after the year. So like once you do your W-2 deferral, like the 23,000 from W-2, you can still do a pension match after the year, and that's sort of like our projection planning that we'll do. But you have until September 15th if you extend, or March 15th if you're not extending, or April 15th if you're not extending, depending on the circumstance. You can do the 401k pension match. So we use that as a wiggle room. Sometimes we clients wait until the end. Maybe they don't have the money, and they'll get a deduction there. But that's sort of like part of the whole planning. But in order to get a 25% match on your which is based off your salary, we have to make sure your salary is high enough to be able to maximize that, so you can do some of the things afterwards. But you have to plan certain things before year end. So a big thing also is QBI deduction. Now that's called qualified business income deduction, and most businesses get that unless you are making too much money and you're a lawyer, you're a doctor, you're a specified service trader business, and if you make more than like $400,000, you're just not gonna get that 20% deduction, that's what QBI is. It's a 20% deduction on your business income, and there's limitations, and the limitations are subject to looking at two things. Salary. So 50% of your salary is the limit of how much your deduction could be. So if you made $1 million after salaries, you can get a 20% deduction on $1 million. So that's $200,000, 20%. But your salary has to be $400,000 in order to be able to get that $200,000 deduction, because it's limited to 50% of your W-2 wages. And this is only a limitation if you make over the QBI income, where it starts testing these limitations. So that's something we have to plan for. Some clients, there's a sweet spot formula actually, that your salary should be all your salary. Sometimes you have other employees. Some businesses actually pay other people, which includes all those salaries. 30% of your net income before salaries should be your minimum salary to be able to maximize QBI deduction for those who are getting limited or getting tested by that 50% of wages. Now, for real estate owners, it's tested. You also can get QBI for those who are involved with QBI. There's all the safe harbor stuff. It's 2% of your net book value of your assets. So it's another test. That test is less prominent in the happening. But anyway, so QBI is a major thing. I've seen clients get so royally screwed because they didn't take any salary, or they didn't take enough salary, and they were making way over the limits. And I remember when I was in another firm. By the way, I run my own firm the last 2 years. I don't know if I can ever go back to working for anyone. I mean, I like being around people. I like being able to talk about other things with other professionals. But literally, I'm making more money and doing like a lot less work, and it just, every time I look at the numbers, it doesn't make any sense. So, but when I was working for the boss, he had a client, and this was a couple of years ago, and we kept on reminding them, hey, you got to do your salary. We don't see salary. Lo and behold, they just didn't get to it. Super wealthy, but still, it doesn't make sense to lose out on that 20% deduction by not having enough salary or any salary. So they got royally messed over, and that's something you got to do before year end. So be careful with that. I'm looking at my list over here. Some cash businesses will prepay some expenses if they need that stuff anyway in January. You might as well buy it in December. Beef up some of your things, prepay some rent, insurance, supplies, whatever you can do. You do that on cash basis. We talked about retirement maximization, retirement planning is something we do now. Charitable planning. A lot of times you might be itemizing and you do charity every year anyway, or maybe you want to shift more charity to 2025, and then in 2026 the charity that you would have given, you gave already in 25, so you can tell the temple or wherever you give your money that I'm giving you money for 2025 and 2026. You can do this either directly with your organizations. You can do a donor advised fund. A lot of people like to do that, so it's as if you contributed it and then you can distribute it later. So a lot of people do that, and there's a bunch of clients that will also it's probably mostly prospects that will kind of define how they did with the real estate transactions. Are they a real estate professional? We'll try to figure out if they qualify, which helps them to be able to figure out, okay, well, maybe we should do a cost segregation study. Okay, I said the buzzword, the cost segregation study. And if anyone doesn't know what a cost segregation study is, it basically takes your property, and instead of doing the 39 years or 27.5 year depreciation on the building and getting that slowly, you hire these cost segregation firms. They carve up on paper what your building is and split it out into different asset classes. And asset classes under 20 years, you can do bonus depreciation, which means you can accelerate depreciation and take a ton of depreciation in the year that you're doing this cost segregation. And you don't have to buy the property in 2025. It could be a property that you bought in 2015, 2021. If you bought it in 2023 or 2024, you can still take some bonus, but bonus was dumbed down a little bit to get less. I think it was like 60% or 80%. So you got to be careful. You can still do a good job there, but in 2025, if you've got a property, we can do cost segregation studies. So we study that. But why am I saying that right after the real estate professional status, rep status? Is because you can create this big loss, but you can only real estate by. Oh, I'm saying tons of stuff here because I hope I'm recording this. You can really real estate is passive by nature, so a passive loss can only be offset by passive income. So if you do this cost segregation study on a $2 million property, and let's say 40% of it could be depreciated, accelerated in that 1 year, you have this huge loss. By default, you can only offset other passive income. So if you have a ton of passive real estate income, in this case, you can offset that. But if you didn't, it's just going to carry forward until you have passive income. So, but if you're a real estate professional, and that means you're spending enough time. That means you're doing a 700 of the hours per property. You're passing all the material participation tests, then you could take that loss from real estate and it gets converted through basically checking a few boxes on the tax return that you are a non-passive person, which means it's active loss, and you can offset it against active income. And if you have active income, you could offset that. Most of the time, people who are active in real estate can be fine, but a lot of times this real estate professional status, let me try to build this a little bit. Real estate professional status works very well for spouses. So the typical situation is you got the doctor, it could be male or female, who's making $2 million, that's active W-2 income or whatever kind of income. Maybe they have their own practice, S-Corp income, whatever it is, multiple different incomes active. But he or she is not the real estate professional. They're the breadwinner. Then they got the spouse, man or woman. I have to be very politically correct here. Most of the time it's the woman. They like the real estate stuff. The man likes just going to work and coming home. So the wife is real estate. She's buying up properties. She's managing them. She's spending all the time. She's the real estate professional. We do the cost seg on that. It's funded a lot by the husband because he's got the bucks. They do a lot of mortgages or whatever. And now she does cost segregation study. She gets this huge loss. And when you're doing a joint return, you can jointly offset each other's income as if you're just one big family, one big happy family right now. So that's the strategy that really works well. But you can be single and be a real estate professional, and you can have some other interest income or other kind of ordinary income. Maybe you get a little bit of a W-2. Let's say, you somehow make $300,000 on a W-2, but it's part-time because you got to be part-time. You can't do more W-2 work than you do real estate work to pass that. So you get this ordinary income, whether it's interest income, whether it's active income, whether it's some kind of other business, but you can offset your real estate because you're a real estate professional. So that's an amazing thing to look into. Should you do a cost segregation study? And that stuff takes time, so it doesn't have to necessarily be now until the end of the year. You can do it next year, the cost segregation study. But the idea is that let's try to figure out if that's something you want to do. And then a lot of the stuff that we're trying to plan for is, do you owe tax or not? Look, I should really talk to the people who are joining here. I want to write off a second home in the mountains somehow, by Zach. Okay. Go ahead and write off a second home. So if it's a personal home, you can write off certain things as a second home. Like if you're itemizing, you could take mortgage interest, you could take real estate taxes, but anything you can itemize on. A second home, if it was rented, then you have a rental business. So you put it on your rental property business form, Schedule E in most cases, and yeah, you can write that stuff off. You can do a cost seg. You might not really need a cost seg because the depreciation might wipe away all the income there, but that is pretty much the answer there. a second home, multiple homes that you live in, vacation homes. It's just like another thing. It's mortgage interest is limited if you have more than $750,000 of loans out there. So the interest part could get limited unless you had your mortgage before 2017. And real estate taxes, that's also limited now, $40,000 like we spoke about before, Schedule A. That's it. If it's personal, it's personal. How many days do I need to rent it out to be a business? So that is a great question. If you rent it out for 14 days or less, you don't have to pick it up as income. So that Augusta rule that I was talking about earlier, if you might have saw that, people do that. You don't find that too often, but we used to have people in California who had luxury homes and they did a photo shoot or some kind of thing and they rented it out for $20,000. And guess what? If it's less than 14 days a year, it's tax free. Any more than that, after it's so that's the answer. If it's more than 14 days of rental, then you have to pick it up as income. And the deductions are pro rata. So you'll see on the schedule how many days did you rent out your property, how many days did you use it for personal, and prorated. So if it's 5% rented, so you take 5% of your overhead. And there's formulas in the tax software. You can do it in Excel. You can kind of figure it out. Okay, I don't even know how many people are joining here. So I think that's it for today. This was my first live session, and I don't know, I keep on seeing things that like you gotta go live once in a while to become popular. So I went live. I had about 3,100 followers, and I don't know how many followers I will have after the session. Well, it was really nice talking randomly about the stuff I do, and I look forward to providing more value as a tax strategist who helps business owners and investors and individuals save money on taxes and kind of sleep at night.